Welcome to another live stream. Got quite a bit to talk about in today's video because the price of gold and silver, it's pulling back, and I think it has a lot of people questioning their value as a safe haven. But the problem is that we are nearing the end game in this levered up economy, and the implications for gold and silver will be significant, to say the least, as well as for the purchasing power of all of those fiat dollars floating around out there. And especially for new gold and silver stackers, new folks to this space, I think it's very important to put this recent pullback into context and to understand what the real end game for this economy is. A lot of folks, I think, got started fairly recently. The silver squeeze, for example, when that was happening a couple years ago, I think a lot of people got tuned into the precious metals. Even more recently, back in March, the banks were beginning to fail. We know that a lot of folks were getting into precious metals at that time because we saw the supply dry up. But now, seeing a pullback in the price of precious metals, and if you haven't been in this gold and silver game for a long time, this could be frightening. This could be very disappointing to you. So, very important to look at this in context. Now, one thing that happened in a recent live stream, I was doing it the other day, and I mentioned a forecast for how low the price of gold and silver could go. Some folks in the chat were asking about that, and I guess the audio got cut off. So before we really delve into the subject matter of today's video, I want to just look at this chart briefly, and it's one we've looked at before, but some people seem to think that I was intentionally obfuscating my silver price forecast or something like that on the live stream. I don't know. There was an audio glitch. It happens sometimes, especially on these live streams. And so the number I threw out there as a potential low for the price of gold and silver was around $15 or so, $16 to $15. And the way I arrived at that was, this is a long-term chart of the silver price. And you can see this goes back to the high back in 2011. And I've drawn a long-term downward trend line. And then also, simultaneously, you have this cup and handle formation forming in the long-term silver price chart. And right now, silver is kind of trading within this range. Now, how low could silver go if we do get a pan sell-off or something like that? I think we could see it go as low as, say, I don't know, 14, 15 bucks, based on this chart, based on where silver has been trading recently. So I just wanted to do that kind of as some housekeeping, because I know a lot of people were leaving a comment there. What was your price forecast? So that was it, folks. Now, if you do want to take advantage of this pullback in the price of gold and silver, which I view as a huge opportunity, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. And certainly, right now is a good time to check that offer out. With the pullback that we've seen in the price of gold and silver, I would look at that spot price deal and at least consider it. Not financial advice, of course. Nothing in this video, by the way, is financial advice. Just a guy on YouTube sharing his thoughts on these markets. But here's one reason why I think this is an opportunity, this buying opportunity. And this is this headline that we just got. This is from AP News. Surprise, surprise, government shutdown averted with little time to spare as Biden signs funding before midnight. Yeah, really shocking that they're going to borrow more money. They're going to continue running up the debt to fund the government. Clearly, all of this talk about a government shutdown was nothing more than fear-mongering. Just like with the debt ceiling, they always float out Janet Yellen, they float out some various member of the Fed or the Treasury. They talk about what a disaster it would be if we didn't keep borrowing more money to keep this thing moving along. And in some way, it's true that, a sudden shutdown could in some ways prove disastrous, but the bigger disaster and the real end game for this financial system lies in the fact that you cannot continue to finance your spending via borrowing indefinitely. Now, I mean, that seems like a very simple statement on its face. Anybody out there who manages a household understands that, you can't just keep putting the bills on the credit card indefinitely, and yet that is how we are running this country. Now, this bill, this emergency bill that Biden signed before midnight, before the cutoff date to keep things running, I think it keeps things open for another 45 days. So, I mean, 45 days from now, you're going to see more drama about this. You're going to see more Grandstanding probably by the folks on the right side of the aisle telling us, oh, we've got to get this spending under control. And of course, they're talking about cutting spending to the Ukraine war and things, which, rightfully so. We should probably not be funding that when we don't have any money here to even run our own government. But, they're not going to touch any of the real major spending issues. They're just not going to do it. They're not going to cut Social Security, Medicare. I mean, we're on the verge of World War III. They're not going to cut defense spending. And so, the government is out of money. I mean, that's really what you can take away from this. And that the only way they're going to continue funding it, well, I mean, you tell me how you think they're going to fund it. Are they going to tax, enough money to fund things? What are they running right now? A $2 trillion deficit? So they're going to up taxes by $2 trillion? I don't even think that's possible. There's not enough wealth out there in this economy, which is falling apart before our very eyes. So how are they going to do it? Well, we are going to pay for it via taxation, but it's not going to be the kind of taxation that most of us are familiar with. It will be via the hidden taxation of inflation. That is just how it is going to be, it looks like, because, again, we look at the debt clock all the time, but hello, $33.1 trillion in debt and growing, and, not to mention the unfunded liabilities. This is the money that we are going to be borrowing in the future, $194 trillion to pay for Medicare and Social Security and all of the government benefits which exist and all of the government programs which the government at this point, with the way things are set up, they're on the hook for. So they're going to continue the borrowing indefinitely. Yeah, there will be political grandstanding and drama in Congress about, whether or not to pass this bill or that bill. But ultimately, both parties are committed to continuing the spending. They have to be. It's the only politically viable alternative for them at this point, given how deep in the hole we are. I mean, they can't cut Social Security benefits. What do they call that? The third rail of American politics, because if you touch it, you fry, right? Just like with the subway system, you touch the third rail, you get electrocuted. Well, that's how it is with these entitlement programs. And, I think they're funding right now some kind of a study into resolving the U.S. debt, but, they can study this all they want. There's no way to do it other than either embracing austerity, paying down the debt, increasing taxes and cutting spending, or, paying it all with devalued currency, which is very likely what we are going to see. And I know that if you're new to stacking gold and silver, it might seem frustrating. You might think, why isn't the price moving up? I've been told that it's going to move up. I get comments like this a lot on this channel. People saying, oh, I've been hearing this for 20 years. Well, for one thing, if you started stacking 20 years ago, 23 years ago in 2000, what was the price of an ounce of gold? It was like $250. So, if you've been listening at that time, you'd be doing pretty well for yourself. But the bottom line is that this has been baked into the cake for some time. Even Alan Greenspan, he's the former chairman of the Federal Reserve. He's kind of the guy who got this whole current mess kicked off in the first place when he slashed rates following 9/11 and the dot-com crisis, inflated the giant housing bubble, and then, what that led to. That led to the QE, the debt monetization, all this stuff, and we've been on this path ever since. He told us in congressional testimony, he said, regarding Social Security specifically, but I think you can apply his statement to just about everything. He said, we have a system that moves cash around, and we can guarantee benefits in any amount, but we cannot guarantee their purchasing power. And that is inherently the problem. Now, at the same time, we've got this international situation where foreign holders of U.S. debt, they're not buying it up anymore. The Chinese are dumping their debt. We've got deglobalization. And what's happening here with the price of the precious metals? For one thing, we're likely on the verge of a massive crisis in the economy. If you haven't been paying attention to the debt sell-off, this is the chart of the 10-year yield. This is very important. It's important to understand how these debt markets work with U.S. bonds and just debt instruments in general. When you see the yield, this is the yield, mind you. So this is, if you buy a new 10-year treasury, this is the yield that it's going to have. As you see the yield begin to move up, that means that the bonds are selling off. Okay, so bonds go up, the yield goes up, the price of the bonds goes down. And another important thing here is that with an economy where we have a tremendous amount of debt like we do, the interest on debt is very, very important. Interest rates, when you're experiencing record high levels of credit card debt, record high levels of government debt, record high levels of student debt, record high levels of corporate debt, when interest rates have been kept artificially low for a very long time, it has encouraged a huge amount of debt to be taken on. And now rates are moving up. And this chart, if you look at where this yield is at, the last time that the yield on the 10-year was this high was in 2007. You've got to go back. I'm going to try and do it on this chart here. Yahoo's a little funny sometimes. Yeah, you got to go back to 2007 to find a time when yields were this high. And guess what happened at the end of 2007? The onset of the Great Recession. But what's different between now and 2007 is that there is a tremendous amount of debt present in the system that wasn't present then. I mean, sure, yeah, we had a lot of debt then too, but that problem has gotten drastically worse by the Fed keeping rates artificially low and encouraging entities from the US consumer to students to businesses to Congress and the Treasury to just accumulate these massive levels of debt. And now, the obvious consequence of that is that we've seen inflation skyrocket, kind of come down a little bit, but now it is starting to tick back up. And by the way, it never really got close to the Fed's 2% stated target. Now, I'm going to pause real quick here. We've got 181 people viewing, 32 thumbs up. I just want to say a huge thank you to all of you who have liked this video. And if you would just do me a quick favor, if you find this information valuable, if you find this helpful, please do take 1 second, smash that like button. It helps get this information out into the algorithm, helps spread the word about sound money. And this in particular is a very important message, I think, for new stackers, because I would hate to see folks who stacked over the past couple of years. Now, mind you, this is not financial advice. I'm not telling you what to do. But I would hate to see you take gold or silver that you bought, you see the current sell-off, and you panic a little bit, you get a little freaked out, you get maybe a little disgusted saying, hey, I thought this stuff was supposed to go up. Look, ultimately, unless they fix the problems with the debt in this country, unless they fix the deficits, the only way they're going to pay this stuff off is with devalued currency. And that means massive inflation. And I think that's right around the corner. Now, one thing I will tell you is that the sell-off that we are seeing in the price of precious metals is indicative that investors perhaps believe that the Fed will be successful in bringing inflation under control and fighting this runaway inflation. They think, yeah, the Fed is going to keep interest rates higher for longer, which they probably will have to do. But ultimately, here's the thing. Something's going to break, and I think it's going to break very soon. And I think we'll look back on this time right now before this crisis kicks off in a very significant way, and we'll be kicking ourselves saying, I wish I'd stacked more. Now, yeah, like I said earlier, I do think that the price of silver, the price of gold could fall a bit more. If you look at the gold price in context, look at the yearly chart. Here's one from SD Bullion. I mean, gold really hasn't fallen that much. We're still up year over year. In November of 2022, gold was under $1,700. So, yeah, we are off of the highs, that's for sure. Kind of to be expected considering the fact that the Fed has been cranking up rates. But the thing that you got to understand is that the Fed is going to break something here. I mean, if you want evidence of that, we covered this chart in the most recent live stream, but this is critical. This is the Bank Term Funding Program loans. This is the emergency credit facility that the Fed launched back in March when the banks began to fail. This is a facility by which the Fed will take on bonds, low-yielding bonds that the banks have all these losses on, these unrealized losses. And rather than the banks being forced to sell those bonds to raise liquidity when depositors are pulling out funds, they can take those bonds that have been devalued because of the rising interest rates. They can give them to the Fed as collateral, but the Fed doesn't take them at their market value. They take them at their face value. It's worth, the face value on these bonds is much higher than what the bonds are actually worth. So the Fed says, no, don't worry, you won't have to sell those for a loss. We'll go ahead and take them, put them on our balance sheet, and we'll give you cash in return. Now, this facility is an emergency facility that was launched in March to help bail out these banks. But if you look, it actually just hit a record high. So everybody's talking in the mainstream media about how the fear of a banking collapse is behind us. There's no need to worry. But then if that's the case, why is the emergency credit facility still at a record high? I mean, it just went up $117 million the past week. It's under $108 billion, right under $108 billion right now, and it's continuing to rise. So clearly, the banks are under a lot of stress. I was watching the most recent Peter Schiff live show, and he made a very interesting point as well, and that's that not only are the bonds that these banks are sitting on accruing losses as interest rates continuing to move up, but think of all the mortgages. The mortgages work just same way as the bonds. If all these folks who took out mortgages on their homes at 3 or 4%, now that average 30-year home mortgage is over 7%, those mortgages as debt instruments have lost a huge amount of value, at least on paper. So if the bank was forced to sell those to raise liquidity, they would be losing even more. Yeah, very, very nasty looking for the U.S. banking sector. And, when you also look at the fact that this government shutdown continues to happen, I mean, when was the last time that we heard about the debt ceiling? That was just a couple months ago. It seems like every couple of months, we have some kind of a crisis brewing in Congress where they say, oh, we need to borrow more money to keep everything running. I mean, Janet Yellen essentially during the debt ceiling told foreign holders of U.S. debt that they wouldn't even be getting paid back. They might face the risk of a default if we didn't raise the debt ceiling. So what does that tell us? It tells us that the government is completely out of money. That is why there is a debt ceiling crisis. That is why there is a looming government shutdown now that's been averted because they're going to borrow more money. But the point is, they're out of cash. They're broke. And the debt is growing at a record pace. So unless you think that suddenly this Congress, this administration is going to impose fiscal austerity on the American people, crank up taxes, and begin paying down the debt in a responsible manner, then there's no reason to panic when you see the price of gold and silver falling, okay? I mean, the prices are lower than they were. I'm going to take advantage of that and add to my stack. I think it's very important to leave emotion in a way out of your stacking and out of investing in general. And again, this isn't financial advice or anything. I'm just telling you my thoughts, but Scott Sim in the chat a few minutes ago said something important. He said the best advice he can give to stackers is to not look at the price too often. And yeah, that's critical. I think that's really good advice, Scott, because you got to think of your stack in terms of your wealth in ounces. You've got to understand that the game plan for reducing sorry, excuse me, give me a second here, let me wet my whistle here. There we go. You gotta sorry, I'm reading some of the chat here. I get distracted sometimes on these live streams because I'll glance at the chat and I'll read some comment that catches my interest, and I'll be right in the middle of a rant there and just completely lose my train of thought. So I was talking about thinking in ounces, I think. Yeah, that's very critical. To think of your wealth in terms of ounces and understand that the game plan for the US dollar is to devalue it. I mean, we are being told that by the Federal Reserve. It is their objective to devalue the dollar at 2% annually. I mean, that's not even a secret. Now, of course, they have exceeded their goals here by quite a margin. One thing that's very interesting, Powell used to talk about when inflation first started to go up, when he was first giving us this spiel about inflation being a transitory phenomenon, was he talked about averaging inflation rates, right? Like saying, well, yeah, inflation's over 2% now, but it was under 2% for a long time, so we can kind of tolerate that for a bit. Now that inflation has been north of 2% for a very long time indeed, you don't hear him mentioning this anymore, but you got to remember that all of this inflation is cumulative. You continue to see prices rise. So without any deflation, without having a negative inflation rate, prices coming down, we're never going to get back to, the previous normal level. Even if they were to bring inflation down to 2%, I mean, prices have already been blown up through the roof. So the American consumer, the American way of life here is already experiencing the consequences of a debased and devalued currency. I mean, you experience it every time you go out to the grocery store. That is why credit card debts are at a record high. That is why they just revised the GDP numbers downward, why consumer spending grew at an incredibly slow rate, because we are on the verge of a crisis. And I don't know what the first thing that's going to give out. I don't know if it's going to be The banks fail. The banks need liquidity. The banks are being forced to sell these losing bond positions because investors get freaked out, all or depositors get freaked out. And certainly, if I was a depositor in a regional bank and I had money in excess of the FDIC $250,000 insurance limit, I would be thinking about pulling my deposits out and putting them into a larger bank, one of the too big to fails maybe. Because what did the Treasury tell us? They basically told us that depositors would be bailed out if they exceeded the FDIC limit, kind of on a case by case basis. If it was determined that the bank's depositors were systemically important, then you would get a bailout. Otherwise, well, maybe not. So, I mean, that doesn't instill a tremendous amount of confidence, if you ask me. We are at 83 likes, by the way. We got 263 people watching. Again, a huge thank you to everybody who tunes in and supports the channel. And if we could just get to 100 likes, I would appreciate it tremendously. There's 17 more people. Please smash that like button. It really does help things. And just an awesome group of stackers here, by the way. There's so much good stuff in the chat. I mean, we always see this community demonstrating how they understand what the end game is when you read the comments and the chat on these live streams. But one thing I will say is I have seen some folks who look a little bit despondent in the comments. They're just disgusted with the price of silver and of gold. And I think most of the selling that we've witnessed that has driven the price down has been paper. I don't think there's too many stackers out there selling their physical, although there are some. And really, again, not financial advice, but if you're considering unloading your gold and silver into this decline, I mean, even if the spot prices go lower, I don't think now is the time to sell. From my personal views on this, I really think that now is the time to be accumulating hard assets, taking advantage of these pullbacks, because let's say that we do get a pan sell-off and we see the price of silver, an ounce of silver, drop down to 14 or 15 bucks. There's no way you're going to be able to go down to your local coin shop and pick one of these up for 14 or 15 bucks. It's just not going to happen. We just blew through 100 likes, by the way, so thank you to everybody out there who smashed that like button. I do really appreciate that. We're at 111 now. That's amazing. But yeah, the price of an ounce of silver, even if the spot price, the paper price, the price of a futures contract or an ETF drops down to 15 bucks, I think it's very unlikely that either bullion dealers out there will be selling their inventory for that price, or the individual stackers will be letting that stuff go. One thing I think we'll see is many types of bullion will completely dry up and they will be unobtainable. Like junk silver is the best example of that. 90% US silver. Every time we get some kind of a crisis or a shakeup, that stuff is the canary in the coal mine. It's the first thing to run out of stock, and the premiums on that stuff absolutely explode. And yeah, I think that will repeat itself, but even in a much more dramatic way when this crisis occurs. And then the real critical thing is the response to whatever this crisis manifests itself as. If we see the stock market plummet, if we see banks fail and the depositors be at risk, I mean, the outcries both from politicians and from voters to do something, get in there, Fed, fix things. Well, yeah, there's only one way the Fed can do that. They've got one tool. Anybody know what it is? It makes this sound. It's a printing press. Yeah, that's the only tool they have to fix anything. And they're going to crank that thing on and run it like you have never witnessed before. The helicopter money is going to be unbelievable because it's going to have to be in order to bail out this economy. Right now, the Fed already has expanded its balance sheet for these banks to the tune of $108 billion. Now, they have been selling off some of their treasuries and other assets, so their balance sheet on the whole, following the initial spike caused by the BTFP, has come down. But they are continuing to take on more bonds and assets from these banks, which shows you that the banks are not in good shape. And if you see the 10-year yield spiking, like we've seen it move up at an incredibly fast pace, the last time that the 10-year increased in 3 years, I read that it was 1787 was the last time that we witnessed that, where the 10-year yield increased 3 years in a row, which, I mean, that's even kind of hard to fathom, thinking about that far back in history. But that just shows you how monumentous this move that we are witnessing right now in front of us really is. And investors at large and the population at large right now, even in the light of this massive financial crisis, which has already begun, it's already kicked off, it's just playing out in front of our eyes, still view physical gold and silver as, a novelty or something that someone with a tinfoil hat on in a bunker might have, or something their grandparents might have done. And that is because this information has been intentionally suppressed. I mean, that might sound a little conspiratorial for you, and it's not like I have a tremendous amount of evidence, except you can just look at how brainwashed people have become regarding money and the economy. And I think it itself is evidence of the fact that there has been a concerted campaign. And then you look at other things like the fact that, if you pick up a dictionary from 1970 or earlier, and it has one definition for inflation, the old definition, the real definition, the Austrian definition is inflation is an expansion of the money supply, which leads to rising prices, right? The current dictionary definition, which has changed, is that inflation is the rising prices. So, that is how you get comments like Jerome Powell saying, well, now we understand how little we know about inflation. I'm paraphrasing him there, but basically telling us, we don't really know what leads to the increases in prices. Well, the old definition sums it up pretty nicely, and that's the expansion of the money supply. And that is exactly what the Fed going into the market and buying up nearly $9 trillion worth of mortgage-backed securities and U.S. Treasuries does. It expands the money supply. It is massively inflationary. And the Fed has unwound about $1 trillion of those QE purchases, right? That's not very much, I'm here to tell you, compared to what they've done. And already, as they unwind that, banks are beginning to fall apart, interest rates are spiking up, so the likelihood that they'll be able to normalize their balance sheet in like a real way, it's non-existent. Can't happen. Imagine how high the rates would spike up if the Fed sold off the remaining $8 trillion worth of treasuries on their balance sheet. Remember, China is selling U.S. treasuries. Japan is selling U.S. treasuries. There's a lot of competition to the Fed selling those. The Treasury is selling U.S. treasuries at a record pace. We have a huge deficit going on right now. If you look at the numbers, they are spending, hundreds of millions of dollars an hour that they don't have. It is incredible the pace at which this deficit is increasing the already massive US debt. And what that guarantees us is that the real end game, the Fed is going to have to reverse quantitative tightening. They're going to have to monetize a whole lot more debt. That's the bottom line. Or they can allow everything to fall apart. They can allow the economy to implode. They can allow everybody to lose their jobs and the 401ks to lose all of their value. They can allow the stock market to plummet, the banks to go out of business. But guess what? That's not going to happen. There's no way that there would be the political will to do that. Look at some folks, there was a video I did recently where I quoted a letter, an open letter that Elizabeth Warren had written to Janet Yellen. And folks in the comments were tearing me up for even citing this, saying like, oh, how could you agree with Elizabeth Warren? And trust me, Elizabeth Warren and I agree on very few things. But she was pointing out the dangers of maintaining interest rates at a higher level for longer. And, she has been a huge proponent of Powell cutting interest rates right now, abandoning this restrictive policy, because she is one of these modern monetary theorists. And, this is a view that I think you would be surprised how widespread it is among our leaders. They think that you can just borrow and spend yourself into prosperity, that consumption is what drives economic growth, that borrowing endlessly has no consequences. Of course, I mean, that is all absolutely nonsense. But Elizabeth Warren was right in the sense that the economy will break when the Fed hikes rates. Now, the right thing to do here would be allow the economy to break, allow the free market to do its thing, but they're not going to do that. I mean, just look at their previous actions. Nothing in the past 23 years of Fed activity would indicate that they will allow things to break. And I really don't think there's going to be any political will for it. And that open letter from Elizabeth Warren just kind of gives you an idea of what the outcry from politicians is going to sound like once things actually begin to break, and they're going to be out there representing their constituents saying, we need bailouts, we need stimulus checks, we need interest rate cuts, we need the U.S. to increase spending, increase deficit spending to get this economy up and running again. I mean, that is right around the corner, folks. You are going to hear about that. And I think that at the same time, you might hear they'll abandon the inflation fight, and I think there will be a sustained campaign to convince everybody that rising inflation is a good thing. They'll say, hey, you got a mortgage? Well, guess what? You're going to be able to pay it off in no time because interest rates are at record lows. And yeah, the house that you bought for $200,000, now it's worth $1 million. So just pay off your house with devalued currency. And look, everybody's so rich now because all of these assets have gone up in value. Never mind that, a loaf of bread is $100 and a gallon of gas is $50. Don't worry about that. I mean, that is likely where we are headed on the current path that we are on. And I don't see any way for them to fix things other than to, once again, as I said, either pay everything with devalued currency. I think that's the plan. But the alternative is to allow everything to implode, and they're not going to do that. So I would be interested to know what you think. Give me a 1 in the chat if you think that they will allow everything to fall apart and implode and blow up. Give me a 2 in the chat if you think it's more likely that they will pay off the debt with devalued currency, if they will resort to their one tool, the printing press, and they will pay all of these debts and bills with devalued currency. Because time and again, throughout history, that has been the path that the majority of folks opt for. So I'd be interested to know what you think, or maybe we'll get a little bit of both. I see some folks putting 1s, some people putting 2s. It's true, they may have to allow things to collapse first before they revert to the printing presses, because I think what the Fed really wants is they want everyone to beg them to do it. They need some kind of political cover here. If the Fed were to reverse policy today to rescue these markets and to stave off this coming collapse, when inflation runs out of control, who will people blame? I mean, they'll blame the Fed. They'll blame the administration. They'll blame the politicians. But if we get a crisis first, a nice crisis, a good economic crisis, or who knows, maybe a World War III. I mean, there's plenty of potential crises out there. But you know what they say? Never let a good crisis go to waste. It's called problem, reaction, solution. And I think that they will potentially allow everything to collapse enough so that there is an outpouring of demand for them to intervene. Everybody will be begging them to intervene. And that's the scary part. When they start promising people stimmies, those stimulus checks, they start promising universal basic income, like, hey, all you guys got to do is sign up for our CBDC and go cashless and we'll be able to fix everything. And they'll have a lot of, very slick talking, convincing economists. I mean, not convincing to anybody who understands economics, but again, the average person has been dumbed down and, brainwashed in terms of how economics works. Ask most people the difference between an Austrian economist and a Keynesian, and they're going to, look at you like you got a couple heads. So, they'll run a campaign to convince everybody that this is the right way to do things. And that's how it'll go. And I think that eventually what we're going to see is massive debasement of the currency. So, folks holding gold and silver will be able to maintain some wealth outside of this corrupt, rigged financial system throughout that, and perhaps maintain some purchasing power over to the other side. I also think that there will be opportunities for folks who are holding gold and silver to perhaps acquire assets. I don't know what exactly will be on the cheap, but properties, businesses, other hard assets, income producing assets. The economy, the world's not going to end. That's for sure. Crises are a normal part of human history. A lot of times we do it to ourselves. The economy collapsing here is a man-made crisis. It's completely avoidable. But the problem is human nature, and we repeat a lot of the same mistakes that we've made historically. But you got to just get prepared for that, because you got to understand that in a massive downturn, there are folks who do very well. More millionaires were made during the Great Depression than at any other time in history. So, just get ready and understand what's going on. And you got to understand when you see folks out there who are, denying that there's any kind of problem with financing government spending with a printing press, who don't understand economics at all, who think it's great to just finance everything via debt. They probably have a lot of debt, have a lot of unnecessary consumer goods that they go into debt buying, spending money they don't have to buy things they don't need. These are the folks who are competing against you on the economic chessboard. So if you're prepared, if you get out of debt, if you have an emergency fund, if you have hard assets, as we go into this next crisis, you're going to be positioned to thrive and to win. And that's why, this doesn't have to be all doom and gloom. You don't even have to be scared. You just have to get prepared. And so that is what I urge all of you to do. Again, not financial advice. I'm not telling you what to do. You got to do your own due diligence, do what's right for you. But I would view these pullbacks and any potential crisis as a buying opportunity for hard assets. There's going to be a time to swap these out in the future, but we're not there yet. You'll know it when we're there. Eventually, I think that even the metals themselves might go into a huge bubble because there's going to be a huge influx of the, dumb money, the late money coming to the party and realizing that you're going to need to, switch your devaluing fiat digital currency into anything real. That's what always happens when you see massive inflation. Folks rush into anything real that you can hold in your hands, whether it be, silver, gold, cars, homes, ammo, boomsticks, whatever. Any of those things are going to be good inflation hedges. But I think gold and silver, for one thing, they don't take up as much room as some of those other things. And also, I think that disproportionately they will see their purchasing power, the purchasing power of real money will increase relative to other assets. So that's about it for today's video, everybody. I do appreciate everybody who joined. I see 154 likes. That is so awesome. You are doing your part to help spread this information, and I'm going to continue to do my part to keep you aware of what's going on, at least as I see it. This channel isn't anything without any of you. So again, leave me a comment down below to let me know what you think. Thank you so much for everybody who joined me today, and I will catch you next time. Stay safe and happy stacking, everyone. Smart Silver Stacker, out.